Welcome to KYC, that is Know Your Company. I am Mahima Vachrajani, and if you are somebody who is interested in the retail space, especially in the clothing side of things, then today's KYC for you, because on today we are talking about V-Mart retail, and we are going to dissect as to how the financials are looking like and lots more. Let's take a look at what are the parameters that we are going to take a look at for the KYC show. But before that, let's take a look as to why we have chosen V-Mart on KYC today. First of all, the GST rationalization impact will be there on V-Mart because they have sub that 1,000 rupees per product selling price. So they will be a company who will benefit from this entire GST rationalization. The second one is what is the kind of same-store sales growth target that they're aiming at, because Q1 was largely impacted because of monsoons plus Eid preponing to the last quarter. So we'll have to see as to how same-store sales growth targets are looking like from here on for FY26. Thirdly, I also want to know with regards to the competition that's shaping up, because there are counters like Trent coming in, Shoppers Stop coming in and saying that they're going big in terms of store expansion. What are the kind of expansion plans that V-Mart has, and what is the one USP that V-Mart has which others don't? Next, store expansions, like I talked about, I want to know as to what is the kind of store expansion planned for FY26 and how will the funding take place. In terms of online presence, this is something I want to know. This is the era of e-commerce and quick commerce. How is the company planning to tap more into the e-commerce space is something that I would want to know. And lastly, Limeroad, the business which runs on commission, the path to break even, what is that looking like? Because Q1 itself, the losses have cut down over 56% for this particular business. So these are the things that I would want to know from something like a V-Mart, and that is why we've taken up to study this company. The parameters that we're going to look at includes your income statement, your balance sheet. These are some of the parameters that we look at in terms of the know your company aspect. But a brief about what the company does. It is basically into the business of value retailing through chain of various stores. You would have seen a V-Mart store in Tier 1, Tier 2, Tier 3 cities. It has more presence in the Tier 2, Tier 3 and Tier 4 cities. It is focusing on fashion and value conscious products that it sells. Majorly, it sells clothing, but it also has certain footwear and accessories presence in the markets, in some markets as well. In terms of where the network stands, as of Q1 FY26, it has around 510 stores, present in 315 plus cities and in 28 states. Now, strong presence is there in states like Uttar Pradesh, Bihar, Tamil Nadu as Jharkhand. So states which are population heavy and have more presence in the Tier 2 and Tier 3 cities, there is more presence of V-Mart in those cities. In terms of the business divisions, the V-Mart Aspire, it caters to the young generation that is present. So it caters more to the kind of generation that is looking at more fashionable clothing. V-Mart Plus caters to all age groups right now. The next one in terms of the business division, we have V-Mart Corporate that targeted customers anywhere between 22 to 25 of age. So again, value conscious, but at the same time fashionable clothing. V-Mart Values caters to all age groups, focusing on basic needs. So from the smallest cloth in your wardrobe, they cater to that particular segment. Limeroad is an online fashion marketplace that basically runs on commission. So this is the fifth business division that they have in place. In terms of the revenue mix, V-Mart is around 83% of the total revenue mix. Unlimited is around 16%, and just 1% right now is Limeroad. So the question really here is that as to how going forward also this Limeroad contribution to the overall revenue will increase is something we would want to know. Now going on to the parameters that I was talking about, what are the kind of parameters that we're going to look at? That includes first one being income statement, then balance sheet. We'll also take a look at as to how cash flows have fared, return ratios, what are they indicating, what's the shareholding pattern like, street cred, and in terms of valuation, where does it stand, and lastly in terms of what the analyst recommendations are and the guidance and outlook given by the company, and what is the kind of tone in terms of where Q1 FY26 commentary stands. So these are the parameters that we're going to look at, the 8 parameters of which we'll be also be giving ratings. Let's take a look at the first parameter, that is income statement. In terms of where the income statement stands, well, the company has been a strong performer in the past 3 years. If you take a look at the 3-year CAGR, 25% growth is what we've seen in terms of revenue. EBITDA growth stands at around 23%. Overall margins have remained steady in that range of 12 to 11%, but because it is value conscious, it is also difficult for them to increase the margins from that 12% mark. Net profit has also seen a good CAGR of 57%. So overall things looking stable with regards to the 4 financial metrics that we look at generally. Q1 performance also, overall they saw a growth of 13% in revenue YOY basis, EBITDA growth of 27%, margins stood at 14.3%, but this we would want to know as to how sustainable these margins are, and net profit at around 33 crores versus that of 12 crores earlier. So that's a twofold jump that we've seen there, more than a twofold jump. In fact, if you take a look at the net profit trajectory also, the company did incur losses in FY23 and 24, but did turn profitable in FY25. With regards to where operational metrics are concerned, the operational metrics have been improving for the company. Overall footfall has seen an increase of 14% in Q1 FY26. Conversion rates stood at around 48% versus that of 47% earlier. The average transaction size, though decreased 3%. Average selling price has also seen a downtick of around 1%, and this is because Q1 ideally is not festive season for them, plus Eid being preponed to the previous quarter has impacted the quarter particularly. Overall, the store count went up by 14%, and so did the retail space of the store count. So the sales per square feet metrics has also been improving for them, is up 1% in Q1 FY26. So this is with regards to where income statement stands. Overall, operationally and in terms of where financial stands, it's been a good growth for the company, and that's why we've given a thumbs up where income statement is concerned. The next one is balance sheet. Strong balance sheet, because in terms of the overall growth in terms of other reserves has also been at a steady state. There is no long-term borrowing for the company, no long-term liability in the balance sheet, just short-term borrowing, which stands at around 149 crores. The cash and bank position has been improving, although right now the cash and bank position is not enough to cover the short-term borrowing, but overall that's not a concern because it's a short-term borrowing. And considering all of these, we've given a thumbs up because short-term borrowing, no long-term borrowing on the balance sheet, plus cash position also improving and other equity growing at a steady rate indicates a healthy balance sheet. The next one is cash flow statement. Here, in terms of where the cash flow from operations stands, mainly a cash business. So it's very important to see as to how cash flow is getting converted into the EBITDA metric as well. Cash flow from operations has been on a constant rise in the past 3 years, from a 177 crore to a 349 crore in FY25. As a percentage to EBITDA, the cash flow has also improved significantly, though FY24 was an exception at 180%, but FY25 also at 92% was a very healthy conversion when it comes to cash flow being translated into that EBITDA number. Lastly, in terms of net cash flow position, that has also turned to a positive number. So all green flags here, and that is why we've given a thumbs up here yet again to this particular metric. So thumbs up to income statement, balance sheet and cash flow. The next one is return ratios. Well, this is where the company needs to improve on. It's a weak metric for them because overall return ratios have not been able to cross the double-digit mark at all. FY21, it stood at around 4%, then went to 5% in 22 and 23. Then went down to 1% in FY25, but FY24, FY25 it stood at around 8% odd. So since it's not, generally we expect ROC to be in that range of over that 15% mark, which the company has not been able to cross, which is why we've taken a conservative approach here, and we'll have to see as to how this metric improves for the company and given it a thumbs down. The next one is shareholding pattern. For this particular company, it's a well-held company where promoters are concerned. Consistent holding of 44% in the past 3 years by the promoters themselves. So promoters have shown confidence in the company. We also have FIs that have increased the stake in this particular counter slowly and steadily from a 14% to a 15% and 17% and 18% as of June 25. DIs have remained stable, slightly here and there, 31% in March 23 to around 34% in March 24 to around 31% as of June 25. So stable, rate of holdings by the DIs as well. In terms of public shareholding, that has come down a tad bit from a 9% in 2023 to to around 6% in June 25. But overall, that's not a concerning factor at all, and that's why we've given a thumbs up as to where shareholding is concerned, because it's a well-held company, both in terms of promoters and FIs and also DIs. The next one is Street Cred. In terms of where Street Cred is concerned, the overall stock performance has been a bit of a concern. 1 month performance, the stock is down by about 4%. 6 months, hardly up 1%. Year to date, the stock is down by about 26%. 1 year, the stock is down 27%, and 5 years, the stock has given returns only of 41% to the shareholders. So the reading here is that despite the company seeing growth in terms of the overall metrics, overall revenues as well as profits, and even cash flows improving and balance sheet having a healthy position, share performance has not reflected that. So we've given a thumbs down when it comes to the Street Cred for V-Mart Retail. Next is valuations. Now valuations have not been cheap for any of these retailers. I've not taken PE into consideration here because for PE metrics, all of these value retailers sit on very high PEs, and it doesn't make sense to value that metric in terms of where retailers stand. So what we've done here is we've taken EV to EBITDA for all of these 3 companies that are peers of V-Mart, that is V2 Retail, something like a Vishal, Megamart and Bazaar Style. In terms of these companies, if you take a look at the trailing 12 months PE, V2 Retail stands at 26 times versus that of 31 times of Bazaar Style versus 17 times of, V-Mart Retail is at 17 times and V2 Retail is at 26 times. It's slightly better than how the peers are doing, but still at an expensive one. And going forward, we are seeing that V2 Retail and Bazaar Style in the next 2 years, the expectations are that the EV to EBITDA valuations will come down quite significantly and not at the same rate as what is expected in V-Mart. And that is why we have taken a conservative approach here and given it a neutral rating. So valuations is a neutral rating for us where V-Mart stands. Lastly, in terms of where ANR stands and return potential and of course guidance, there are 13 buys right now with regards to where the ANR is concerned and Bloomberg consensus is concerned, 1 hold and 1 sell call for the company. The return potential, of course, is indicating at a higher end of 45.5%, and this is because the company has not done much in the past 5 odd years. So hopefully this year should, if these analyst recommendations come true, it could give a return potential of around 45.5%. In terms of guidance, management expects a mid to high single-digit same-store sales growth for FY26. Optimism for Q2 and Q3 is there due to festive season, and now GST 2.0 has also come in, and that could probably aid the demand for these value retailers. And positive on demand recovery going forward is something that's the tone and tonality of where the management conversation is concerned. But in fact, we also had but before I go on to that, let's take a look at how the ratings have panned throughout for V-Mart Retail. Out of these 8 parameters, income statement a thumbs up, balance sheet a thumbs up, cash flow also a thumbs up, but return ratios is a thumb down for the company. Shareholding again a thumbs up, Street Cred thumbs down, valuation a neutral rating because overall not cheap as compared to peers, but going forward the forward valuation is not looking very attractive, and thumbs up where ANR and guidance is concerned. So overall rating of 5.5 out of 8 for something like a V-Mart Retail. In fact, we also had a conversation with Anand Agarwal, the CFO of V-Mart, and listen in to what he had to say about GST picking up and festivities kicking in, and what are the demand trends looking like. My first question to you is, what's the kind of traction that you've already started seeing? The festive season has kicked in, the GST 2.0 has kicked in. What is the demand trend looking like?
Mahima, I think while it's very early, it's just been 2 days and I just have sales report for 1 day, frankly, to understand how the traction is looking like. But from what I can see is definitely there is much better footfall traction that we are seeing. There is more positivity in the consumers. There is, more willingness to come and look for products at the stores across the country that we are able to see. I'm not really certain that all of that is attributable only to the GST, but also probably because of the onset of the festive season, which has just become 2 days back, which has just begun 2 days back. But I think the mix of both the things is definitely going to give us some positive results in the times to come.
What percentage of your apparel sales currently is above that retail price of 2,500 and below 2,500? What is that breakup? And what will be the impact of GST rationalization, if you can give us that perspective?
So as a value retail apparel player, we are predominantly, priced sub 1,000 rupees. We really don't sell a lot of products above 2,500. But even from a 1,000 rupee benchmark perspective, where the earlier GST rates were 12% and which have now got reduced to 5%, so that's a substantial saving for our customers. So the bigger sweet spot for us is to play around that price point of 1,000 rupees, where our offerings earlier were also very limited. And as we move ahead, as we plan ahead, I think we will now want to explore more offerings in that price segment, because that is now going to get available to the customers at a slightly lower price point because of these savings in GST. So that is something very exciting for us. From a 2,500 perspective, rupee price point perspective, we really don't offer a lot of products. But yes, 1,000 rupees and sub 1,000 rupees is something that we specialize in, and even there we are seeing benefits which are accruing to the customer, which are going to drive traffic and also consumption in the country.
Okay, Mr. Agarwal, same-store sales growth for Q1 was 1%, and this is because all of the retailers face this because Eid was preponed to the previous quarter. Do you think a high single-digit same-store sales growth for FY26 is very much possible, considering the boost in GST plus festivities have already kicked in?
So it is definitely possible, but I will not guide towards that. Probably I'll still stick to the earlier stand of mid to high single digit for the full year. I think we remain optimistic. We remain, irrespective of the GST, our guidance was around that number, around mid to high single digit, and that is something that we still maintain. The GST has definitely come as a boom, so definitely I think it should further help. I'm not too sure how much of that is going to get beneficial for the value retail segment, which predominantly operates in the 500 rupees or below 500 rupees average selling price, but definitely from a consumer sentiment point of view, I think it should result in slightly better numbers for the full year.
The competitive intensity looking like, because a lot of domestic players are coming in and giving guidance with regards to where store expansion stands. How is the competition looking like right now? Any kind of market share loss or market share gain that you're seeing?
The competition intensity has definitely been on the upswing for the last at least 3-4 years. So there is no relentlessness in that. We are, seeing a lot of activity, and that activity also is a testament to the fact that there is more demand, there is more capacity getting created in the market. There's a lot of unorganized retail which is getting converted into organized retail, and that is giving birth to a lot of opportunity for all players. So we have not lost market share, we have in fact gained market share. We would like to consolidate more market share, and we are robust in terms of our expansion plans. We plan to open at least 65 new stores this year, so which is a plus from last year, and every year we should be looking at a stable growth rate rather than looking at very aggressive growth rates, because we believe in a consistent and a sustainable growth journey, and we believe that there's a lot of room to open more number of stores in India and in all the territories where we already are present.
Your losses in the digital business have also reduced. What is the outlook like going forward? When do you expect a break even in terms of your digital business? Plus, in terms of your digital business, what are the trends looking like? Has that picked up quite a bit, considering the kind of wave that has come in terms of e-commerce and quick commerce? Do you think that this percentage as a part of the total revenue will increase from here on, and if yes, to what extent?
So digital currently is less than around 5% of our total business. While it's an important and a strategic initiative, but it does not really mean a very big disruptor for us in the segment in which we operate. We primarily operate in the tier 2, tier 3 towns of India, selling apparel at an average selling price of around 350 rupees. Now, at that price point, digital really does not make a lot of sense, at least in terms of profitability. And there is still a lot of room for growth in the offline business. So while we keep our paddle equally padded on the digital foray, but our mainstay and the focus area still remains the offline business. But yes, as a capacity enabler, we are still investing in digital. We are still continuing with the expansion in digital. And as you rightly said, our losses from the digital business have been reducing by 50% year on year. We are very, close to break even there, but still I would not call out on a date or a year when we will see that happen. Irrespective of that, I think we should see a good amount of growth, good amount of profitability at a contribution margin level coming in from the digital business even in this year.
And what about Limeroad? What's the way ahead for this particular business? Because Q1 saw a significant amount of reduction in losses for that business as well. What's the way forward?
So the way forward still is to maintain the growth momentum and at the same time reducing the losses. So as I just mentioned, the Limeroad digital business that runs the Limeroad.com e-marketplace, the losses on that part have been reducing 50% year on year, and we will continue with that spree. It essentially runs as a omni enabler for the entire V-Mart group, V-Mart, Limeroad, as well as the unlimited brands that we operate across the country. So that unit basically predominantly operates as enabling the omni-channel convenience for the customers of all the three formats, and that is what we will continue to run at, but at the same time reducing the losses by 50%. So in any case, it has now come down to almost 15-16. This should come down to almost 15-16 crores for this financial year, which will be a reduction of almost 50% from last year.
Okay.
So at an overall level, the losses from this business will be insignificant for the overall group.
Okay, so next year profitability is what you're aiming at for Limeroad. Is that reading correct?
I would not still say that, but I'll just maintain that it will become a very insignificant number. Even if we have any losses, it will be a very insignificant number.
Okay, Mr. Agarwal, one last question to you. Any particular new geographies that you're planning to tap into?
We present pan-India, so we expand in cluster-based formation approach. So while South India remains slightly lesser penetrated for us, so that remains opportunity area. We would like to expand more in South, but at the same time not letting go of the focus on the other parts where we already are very strong in.
All right, so that was the management of V-Mart speaking about how growth will fare this festive season. A high single digit is something that they're already aiming at, but a double digit could be possible is something that he indicated. Let's take a look at the ratings once again and take a look at how we've rated V-Mart as a company on these 8 parameters that we talked about. We've income statement, balance sheet and cash flow statement with a thumbs up. Return ratios a thumbs down, shareholding a thumbs up, street cred a thumbs down, valuation a neutral rating, and lastly street coverage and outlook a thumbs up, because the overall tonality by the management seems positive. The overall rating comes out at 5.5 out of the total rating of 8 for something like a V-Mart retail. With that, we're completely out of time on this edition of KYC, but stay tuned, more news and updates on the other side.